The year is 1995. The location is sunny Silicon Valley. Executives from an up-and-coming internet company are in a boardroom listening to proposals about listing on the stock market. They really do not like what they're hearing. They are about to make a decision which will inadvertently create an economic bubble like no other. A bubble that will grow to historic proportions, and a bubble that when it bursts will bring bankruptcy to more than half of the companies in their industry and send the US economy hurtling headlong into a recession, and they don't even know it. So how did we get here? Well, first, we gotta go all the way back to the swinging 60s. Intel, baby. In the days of computers being the size of a room, Silicon Valley was making tech stuff for the US Army and others. Intel was founded in the 1960s, and that's where the tech industry really began to take off. Xerox was founded there in the 1970s, and by the 1980s it was joined by companies such as Atari, Apple, Oracle, and stuff like that. From the 80s to the 90s, the arrival of eBay, Google, and Yahoo cemented its position. And with Facebook, Tesla, and Twitter in the last 20 years, Silicon Valley is pretty much unrivaled. Where does this leave us and our question? Well, it's the 1990s, and the newfangled internet invention has gone from novelty to household item. From the 70s on, firms like Intel, Cisco, and Oracle were growing pretty organically, but in the early 1990s, interest rates were slashed, and that's where our trouble really starts. You see, when interest rates fall, borrowing becomes cheaper, and saving becomes not as attractive anymore, so people either save or invest their money. The media was also talking a pretty big game about the internet in the early 90s, so people, and especially venture capitalists, naturally decided to invest. Companies like Amazon, Beverly Hills Internet, Craigslist, Pets.com, Flues.com, Go.com are founded from 1994 to 1998. After 98, spurred by low interest rates and mountains of cash from venture capitalists, companies like Google, Cosmo.com, Webvan, and MVP are founded. All of these, as well as pretty much every other tech firm in the 1990s, had one similarity. They adopted the get big fast model of growth. Basically seize as much of market share as possible first and then worry about turning a profit later. Sounds great. Obviously nowadays people would scoff at investors who fell for GBF firms, but can you blame them really? You're alive during a revolution basically on the size and scope of the Industrial Revolution. You have spare cash. Of course you're going to invest in any firm whose name ended in .com, even if they haven't turned a profit yet. Anyway, people trace the IPO of Netscape in 1995 as the start of the boom. Netscape hired Morgan Stanley to do some work on the IPO, and Morgan Stanley recommended a $12 to $15 per share IPO. Netscape decided for $28, giving the firm an insane $1 billion market cap. By the end of the first day of trading, it had rocketed to a massive $71 a share. That's a growth of 591% of what was recommended on the first day alone. The Nasdaq really began to swell. From 1995, it had gone from 751 points to 5,000. Something was very seriously wrong, but few people noticed it. The so-called .bomb or .com crash itself is traced back to Friday, March 10th, 2000, when the Nasdaq reached a peak of $6.7 trillion, double of what it was a few years prior. The next Monday, 13th March, excited about the peak, large firms like Dell and Cisco issued big sell orders, and this caught investors really by surprise. Panic started and a chain reaction began. Dell is selling. Why? If Dell is selling, they clearly know more than I do, so I should sell too. The number of sell-offs really began to take off. By March 30th, the Nasdaq opened at 6.02 trillion. By April 6th, it was at 5.7 trillion. A staggering $1 trillion had been wiped from the American economy in just 3 weeks. The impact is hard to put into words. By close of business 2004, 50% of the firms founded since 1994, just 10 years earlier, were no longer in existence. Web titans such as Boo.com, Pets.com, Webvan and eToys were defunct by 2002. The stock market went from 457 IPOs in 1999 to just 76 by 2001. By October 2002, 78% of the Nasdaq's value had been totally wiped out. To put this into perspective, I found a pretty cool stat online. In the 2000 Super Bowl, 17 companies spent a total of $44 million in ads during the show. In 2001, just 3 ads were bought by tech companies during the Super Bowl. That is insane. The legacy of the crash is pretty complex. Directly after, the few companies who survived the culling started to pick up the pieces and try and put their companies back together. There was an industry shift away from, the get big fast model towards a more business plan and profit focus. Investors were far more careful about where they put their money, and venture capital for tech firms became far more difficult to get. That being said, it really did thin the herd and allowed for companies such as Amazon, Google, Microsoft, Apple, and others to become the mega titans we see today. Some say we're on the verge of a new tech bubble, with the likes of social media companies such as Snapchat and Instagram having such large IPOs. Some say we're currently in one, but only time will really tell. But we'd all better hope that we aren't, considering how bad the last one was. So that's it from Holler today, guys. I really hope you enjoyed this latest video on the tech crash. If you did, be sure to like, share, subscribe and comment down below. As always, sources and photo attributions are in the description. Until next time.